Welcome to the Snowbirds Expat Radio podcast, powered by the Snowbird US Day Tracker app. I'm your host, Jerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, welcome to the Snowbirds Expat Radio podcast. Today is we have a guest today who's going to help us with this dilemma, which we get answers from. We asked 10 accountants for their opinions on tax-free savings accounts. Should an American hold it when they're living in Canada? And I swear we get 15 different answers after asking 10 accountants. So we have Christa today from the 49th Parallel, which is a tax firm that specializes in cross-border tax. I'm going to let Christa kind of go on a little bit about her firm. I believe she lives in Jets land, and we had our host talking about the Maple Leafs, and we had this poor sap here talking about the Canucks, and we all have hope in this world. Hopefully one of us will win this year so we can unite this beautiful country we live in. So Christa, tell us more about yourself and your firm, and then we'll get into these this TFSA confusion.
Sure. Thanks, Jerry. Yeah. So I'm Christa Walkden. I'm based here in Winnipeg. I have almost 30 years of experience working with U.S. taxes, cross-border taxes, and estate planning. So I started my career in the U.S. I am a Canadian, but had the opportunity to start my career in the U.S. and it's just spanned the 30 years. So at 49th Parallel, we focus on mostly taxation for individuals and estate, do a little bit of corporate work, but mostly individuals. So that's helping people move from Canada to the US, from US to Canada, Canadians receiving inheritances from the US, Canadian families that have US family members living in the U.S. or were born in the U.S. and are U.S. citizens, U.S. citizens living and working in Canada. It gets especially tricky when you're a business owner. So we sort of cover a whole bunch of different, all things cross-border.
Well, as you're aware, we are in that space as well too. So this is where we've had the opportunity to work with Christa and get to know her as well. So let's jump into this tax-free savings account. I've got questions, but I think you and I can just we have so much information about should an American who's living and working in Canada have this tax-free savings account? What can you tell us right off the top with these tax-free savings accounts, and how do you advise your clients?
So right off the top, I would say I get a little, I don't appreciate, or I get frustrated when you hear you're a U.S. citizen, you can't have a TFSA. That is definitely not the right approach. There's no limitation for a U.S. citizen. It's not that they can't have one. And with most tax things, the answer is often, it depends, right? And so there really is, and you alluded to this at the start, there's sort of a spectrum of advice as to, does it make sense for the person to have a TFSA? There are ways that a U.S. citizen can invest in a TFSA and not pay additional U.S. tax on it. It depends on their tolerance for wanting to pay U.S. tax and adding some extra complexities. And what you talked about at the beginning of the session is there is a variety of different ways that you can treat the TFSAs on the U.S. tax returns. So different accountants are going to have different approaches. And so when I'm working with my clients, I talk about that spectrum of here's how we can treat it. And together we work with both. It's super important to collaborate with the financial advisor, but just get a sense of the client's tolerance and appetite do they want to take on if there's a little bit of added complexity? Do they mind paying a little bit of tax to the US, even though overall it's going to be less than their overall tax liability? So that's the challenge, is it depends. But there's a couple of things that we can talk about today that are sort of best practices and things you can look out for that would lean you to one direction or another.
Well, I'm ready. This is being recorded. I've got my pen. I'm making notes because now when you say complexities, are you talking about the 3520 and the 3520A that have to be filed?
So as a U.S. citizen living in Canada, or a U.S. person living in the U.S. that left a TFSA in Canada, the U.S. has certain reporting forms to disclose an interest in a non-U.S. trust, so a foreign trust, and that's the 3520A, and then the 3520 is when there's contributions or distributions from a U.S. person and a non-U.S. trust. Whether the TFSA is technically considered to be a trust or not, and those forms are required, it's not certain. So the IRS has basically refused to provide any rulings on what they feel the TFSA is classified as for U.S. purposes. So you kind of have to look into what is the structure of how's the account structured at the particular financial institution. Personally, and this is where we get into filing positions. If you take the strictest and of interpretations and say, well, it's kind of like a trust, so it would be a trust for U.S. purposes, and then you would have to file those forms and report the income earned inside the TFSA on the U.S. return. I would say that is the most conservative way of treating the TFSA for U.S. tax purposes. A step in from that, and the challenge there is there are penalties for not filing those forms. So that's kind of where you get into the risk tolerance for the client. But a step in from that is to still disclose to the IRS on the return that, hey, I've got this interest in this account. It may be treated as a trust, but I'm treating it as an investment account. I'm disclosing it everywhere else that I have to disclose it on the U.S. return, and I'm reporting the income. So the IRS shouldn't really be that offended, because they're not, you're not avoiding tax. There's still disclosure. And so that's where we get into those sort of filing positions for the account.
So you're saying that clients have that choice. They could be conservative or they can take a more of aggressive stance. Is that all reported on their 1040s in the States? Is there communication?
It is.
I can say, okay.
It is. And that's where coordinating with the U.S. tax preparer is super important. So I would say most U.S. accountants or in Canada understand the requirements for filing, right? In some firms, you may have compliance departments that are basically mandating that, no, as a firm, this is how we are treating TFSAs, and you must prepare the return this way. As you sort of migrate to more like sole proprietors or medium, mid-sized firms, they may have more flexibility in how they treat the TFSAs. On the other end of the spectrum, there are some practitioners that take an interpretation that the TFSA is considered a retirement account and meets that definition under the tax treaty between Canada and the US. And by taking that filing position, no income would be picked up on the return as the TFSA is growing and earning income. So that's where you've got these, goalposts of filing positions. The middle ground, I would say, is you pick up the income, you disclose it. So you're saying, I have this, but you're not going as far as doing all the complicated 3520A and 3520 filings.
Now, what happens now? So let's say we've taken this stance where we're going to treat it like a retirement account. Now, what about what we hold in it? Is there another issue if this American holds a Canadian mutual fund in that TFSA?
Absolutely. Right. And that's not a problem unique to TFSAs. So Americans living in Canada, back in the 1970s, there was a bunch of offshore, crazy creative offshore activity happening. And the IRS introduced these rules called the PFIC, the Passive Foreign Investment Corporation rules. And sadly, your traditional Canadian mutual fund falls under that definition and category. It's quite unfortunate because an American investing in a U.S. mutual fund, which acts the same way and from an income tax perspective as a Canadian mutual fund, that's fine, but Canadian mutual fund is not. And so it gets into onerous tax reporting and filing requirements. And so generally we try, at least when I'm working with my clients, is we try and avoid having our Americans in Canada invest in Canadian-based ETFs and mutual funds. And so that's irrespective of TFSA or otherwise. RSPs, more flexibility there to be able to invest in those types of vehicles, but TFSAs and regular investment accounts are challenging.
Now, we also hear that there's an issue out there with Canadian banks. They say, don't worry about it. You can hold all these investments in your TFSA. And then they transfer it over to another dealer that might have a U.S. parent. Are you hearing that and then when they do transfer it, these clients will now have this capital gains, which works to their disadvantage in that TFSA. Have you come across any of those situations?
I haven't actually. So I'm not specific. I don't know if that's maybe you could elaborate a little bit, but I haven't seen that scenario.
Okay, so I'm gonna name a few. I don't have to worry about the Canadian banks. They're all Canadian corporations, so they don't have the same kind of reporting when it comes to IRA issues, I believe. But now we have this firm, Raymond James, wonderful firm, by the way, out there. I'm not supposed to mention, but I might as well mention and say how wonderful they are. But because they're owned by a U.S. entity, there's some issues around those RSPs, those TFSA, tax free savings accounts, when they're being transferred over in cash to Raymond James. And all of a sudden now we triggered this capital gains that some clients have had to report because of different reporting requirements with Raymond.
Oh, interesting.
Yes.
So you're not transferring the securities in kind over, but you're liquidating at the originating institution into cash and then bringing it over?
Even if we transfer them over in kind and we liquidate them in the TFSA at Raymond James, now we've got this capital gains distribution that has to be reported.
Yes. Yeah. So the challenge there is that this Canadian tax-free wrapper of the TFSA, if you're touching those underlying investments, they have built-in gain and you're triggering any liquidation event of the underlying investments in the TFSA, that gain would be subject to tax for U.S. purposes.
And that's where you'd have to fill out your 3520 and your 3520A.
Again, depending on your filing position, right?
Okay.
But you definitely need to report that income on the U.S. tax return. Okay.
So we know we know that there's a problem, and like I say, you can take a conservative approach. You can be a little bit more aggressive. How does this thing get correct itself so we don't have to worry about being conservative and aggressive? Is it something that needs to be revisited in the treaty? Because the treaty hasn't really been rewritten since 2009.
Exactly. And that's where when you look at the filing position of, well, it's a retirement account, right? It's quite interesting because the last time that the treaty was ratified, Canada granted tax-free status to the Roth IRA with certain parameters, right? So you've got an American move to Canada, has a Roth IRA. There's an ability to allow that Roth IRA to defer tax-free in Canada. When Canada, if you look at, I think it was some of the documents surrounding the original legislation for the TFSA, CRA or Finance was very open that they actually modeled they looked down to our neighbors in the South and modeled the TFSA after the Roth IRA. So, I'm very confident and hopeful that when the countries sit down, I mean, they've got lots of things to figure out between the two countries with education plans, etc. But I'm confident that because Canada granted, tax-free status to the Roth IRA, that we should see that on the reciprocal side with the TFSAs from the US when they sit down. I'm hopeful.
Yeah, and I guess when we really think about this, when we talk about these TFSAs, you have to be in Canada in order to get the allowable amount that you can contribute. So maybe it's not that big of a problem. So let's say, for example, my family, my wife and I, the kids, the dogs, we mentioned our dogs. We both have kind of Yorkie combination dogs out there, but we all moved back to the United States. And let's say we moved back 3 years ago. So we're really not talking about anything that's really that big of a problem because we'd only have 3 years of eligibility to contribute to a TFSA. So I guess my thinking is, would a person be better off if they didn't have a TFSA if we were still had that tie to the U.S.? Because we wouldn't be restricted to how much money we can save in an account. Because you're going to have to declare the income regardless on worldwide income. So maybe it's not as big as we think it is.
Yeah, I think it really depends on the scenario. Like if you've got the common question of, I'm a US person living in Canada, my life is in Canada, should I have a TFSA? That's, a discussion point. You have another discussion point, I have a TFSA, I'm moving to the US, should I keep it? Right? Often on the latter part, to your point, depending on how much value is really in it, sometimes simplicity is like, we'll wind it up and take that money. And if you're, say, working in the US and you have the ability to make contributions into your employer sponsored plan, you're going to get maybe more benefit by taking that capital and using it to invest in US tax preferred plans.
Yeah, at the same time, too, when you do exit Canada with your TFSA, it's not a taxable event.
It's not.
So you're not going to be at a disadvantage. So, the question or the moot point is that can I keep my TFSA? Well, you're right. Let's keep it simple. Cash it in and invest in, may it be a Roth IRA or contributing to your company-sponsored 401k. I guess you can't do the 401k, but you can still do an IRA if you choose.
Right.
Yeah.
Right.
Okay.
And if you do that and you had this sort of that legacy contribution room, say in your example, say you had 3 years of eligibility in Canada, you moved to the US, and then if you moved back, that 3 years is still there for you, right? During the period where you were a Canadian resident, you don't accrue any contribution room while you're not in Canada, and then you can pick up again when, if and when you move back.
You also brought up a very interesting point. The fact is that, and it's too bad this isn't being recognized, but when a Canadian, we'll call them Canadians or Americans, when they move up north here, they can file an election with their IRA, with their Roth IRA, and still have it subject to non-taxable. Do you find that gets missed a lot? And my other part of my thought process is, I wish they could do the same thing. The American people could do the same thing for us. And we'll call it the IRS. Could do the same thing for us. Say this is a retirement vehicle, file an election. That's something else we need to get working on as well, too.
Absolutely. Absolutely. And like I said, it covers there's not only issues with the TFSA, but there's issues with the education savings plans on both sides of the border. Canada doesn't recognize it has issues with the 529 plan. The IRS has, they've done a little bit better with the RESB with reporting, but still have issues there. With your question about the Roth IRA election, it's missed all the time when I'm onboarding new clients. I ask them, can you go back and see if you made this election? Oftentimes they haven't, but there is an ability to do a late election with respect to that, as long as no contributions had been made once they establish Canadian residency. So it's easily, I guess, fixable.
Now, when you say late, are we talking 1 year? Are we talking 3 years?
Just
doesn't matter.
Late. Doesn't matter.
It doesn't matter. Because it's interesting, and this is where we appreciate Christa, because when you're very set on and your knowledge and your talent has made us, and I know you're very busy, so it's hard for you to take on a lot of work, But we're finding so many accountants out there just saying, don't worry about the election of your Roth IRA. I know, it's a good thing that a lot of my phone calls are just phone calls and they're not video calls, because I'll tell you, my same expression, what? And you got to be careful, because our job is trying to get people in front of the right people. And that's the whole idea of this podcast, is getting these people in front of the right professionals to make sure that they're getting things done right. So really, as we wrap up this podcast, once again, a TFSA, it depends on the situation. If either Americans should own it if they're in Canada, or they shouldn't. That's really what it comes down to.
And I'll just touch on dive into that yes or no answer. To give a little bit more context to it, is the case where you've got a U.S. citizen living in Canada. They have other investment income in their taxable accounts. Okay, so they're kicking off interest and dividends and paying Canadian tax on that income. That's creating high Canadian tax. Our Canadian taxes are a lot higher than the U.S. taxes. And what that does is it creates room in their foreign tax credits basket on the U.S. side. And having that room allows that person to trigger this income, taxable income for U.S. purposes inside their TFSA, and maybe not even pay any U.S. taxes because they've paid enough Canadian taxes on their taxable accounts. And so that's just one example where, and if you do a more conservative or a less conservative filing where you're not doing the 3520 and the 3520A, a U.S. person can take advantage of that Canadian tax plan to invest in a TFSA with little pain on the U.S. side.
So if a person had $500,000 in non-registered investments, they're producing all this investment income, and maybe they have $100,000 to $150,000 in their TFSA, maybe like you say, the income will offset the foreign tax credit that's being generated, would offset any taxes being paid on the TFSA, even doing like proper accounting.
Yeah.
Well, that's all we were looking for. That's great. Yeah, that's something. So really, and that's why the importance of having a great accountant and these planners that do the planning can really make sure we can line these things up, because it's like you say, it's not a yes or no answer. It's depending on the situation.
Right. And as an investment advisor, I mean, I've seen, like I said, where investment advisors sometimes like panic and say, oh my gosh, you're a U.S. citizen, you have a TFSA, we need to close that down right away. And they don't talk to the accountant. Work with the accountant. Be very, take a very collaborative approach, because it may be okay to keep it open. But in other cases, you may say, no, yeah, you're right. It makes sense to collapse it. And this is a tougher conversation for the younger generation, where they're just starting out, and it's a great vehicle for them. And never mind the first time home savers account. I mean, that's depth like that. We get into a whole other discussion about that, which is frustrating for the younger generation if you're a U.S. citizen living in Canada.
Yeah, that's so true. Well, we forgot to mention the immigration lawyer, because whenever we're structuring these teams with these people that are moving up to Canada, we want to make sure we work very closely with an immigration lawyer. So, I'll tell you, but this definitely does this does help on creating and telling the story around the TFSA, so people have a great resource. They can watch this podcast with the many more that we've recorded. So, Christa, thank you very much for your time. We look forward to meeting you in person one of these days, and meeting at the dog park with our little Yorkie crosses, Yorkie teacups, whatever you want to call them. And I think I mentioned we also have a big Bermudoodle. So that Bermudoodle is such a goofy dog. He's so big that he's got to be careful where he steps when the little dogs are around. But I thank you, and I appreciate what you do for our clients, and have a wonderful afternoon. And we wish nothing but the most success with Jonathan Tays joining the Jets. And
thank you.
And our fingers are crossed that maybe Vancouver, or Toronto, or Cal, or the Jets are in the playoffs this year, or early.
Absolutely.
Okay, but I appreciate your time. Thank you for everything.
Thanks for having me, Jerry.
Thank you again for listening to the Snowbird Expat Radio podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.